I'm here this morning with Daniel from FinHem, who acts for a number of our clients in relation to mortgage brokering services. So Daniel, thanks for joining us.
Thanks for having me.
Pleasure. Can you tell us about FinHem and what that's all about?
Yeah, so FinHem's my own mortgage broking business doing residential and commercial lending.
Yep.
The name actually comes from a bit of heritage from my Swedish wife. So Fin is fine arts in Swedish and Hem is home in Swedish. So I jumble those two words together to create the name and brand of FinHem.
And tell us what you do for Sibley Lawyers with our clients.
I suppose the relationship between Sibley Lawyers and FinHem is essentially we're creating an extension for your clients to have more services at no additional cost.
Yes.
So you're creating a whole of service for your client base. And I'm fortunate enough to play one part in that role. So as part of that service is that I'm more than happy to speak with your clients, assess their current lending or future lending needs, because it might not be something they need right now, it might be something they're planning to do in a year's time.
Yes.
And quite rightly, sometimes it's a really good thing to get things started now because they might not be prepared to buy something right now, but in a year's time they could be. Like, because if they've got car loans or personal loans, credit cards, working on what they would need to do, because I would initially do a calculator, just a rough calculation of where they sit today.
Yes.
And then if they did various things like paid off that personal loan or get closed down a certain credit card. Because a lot of people don't realize that. They go, oh yeah, Daniel, I've got these 2 credit cards, but don't worry, I don't use them or I pay them off every month. The thing is, the banks will see whatever the limit you have on those credit cards, times that by 4, and that reduces your borrowing capacity.
Gotcha.
That's a very common thing where people always go and say, right, I don't use it, or I don't know. It gets found out.
Yeah.
And also it'd be a good thing for the client to maybe do their own credit check. So they can go and they can do it for free themselves via Equifax is a good place to go and do it. I'm sure there's a few others out there. So it's, there's no relationship with me in Equifax, but just another place I know they can do it and see what their credit score is, because their credit score can also affect their ability to get a loan, especially with the right lender.
And then if you are in that position and you get onto a loan, because there might be a lender out there that they can use, you can presumably wait a year or 2 with that lender and then hopefully get onto another lender that's more competitive.
Correct. Like I've recently done that for a client that was trying to buy a home in Sydney. They had a very poor credit score, so they couldn't go to a normal lender, the one that's people mostly hear about, because essentially this person, quite rightly, so they earn a very good income, but were a bit loose with their money and repaying. They went on a holiday, forgot to pay their credit card, I think 3 times in a row.
Right.
And so especially that 3 times around a short period of time, that really affects your credit score.
Gotcha.
And so that person's credit score was quite poor, so pretty much most lenders wouldn't look at them. So I had to find a lender that basically ignores the credit score number, but looks at them as how they earn an income, what's their stability like. They assess it on another manner. So that person is paying probably 1% higher in interest rate if they went to a major bank.
Yep.
So the strategy for them is to basically get that loan. So we've got that loan for them now. Keep paying that loan, don't miss your repayment, and then assess it about another year and a half's time to allow for the cycle of the credit score to be washed through. And then once the credit score is at a more appropriate number, then we can refinance to a major lender and save them that way. But this way they can get the loan right now. And it's like it's a solution, because sometimes what we use solution-based lenders, not necessarily, I suppose, the major lenders where it's most competitive.
Gotcha. Well, tell us, I guess a lot of people don't know really, and or might be a bit suspicious, but what is a mortgage broker? What does it really mean?
Yeah, so a mortgage broker, part of the difference being often gets compared to going to a bank or going seeing a mortgage broker.
Yeah.
The difference is going to see a mortgage broker, you're actually working for the client, while going to the bank, they are working for the bank.
Right.
So go and see a mortgage broker, you have the benefit, they are working for you, they want to understand your needs and objectives. And then with that, they can assess what lenders out in the market can best serve that. And like, for example, I have up to 40, 50 lenders that I can choose from. And that can enable me to find the most competitive rate, the features that's going to best suit that client. And also often helps with finding the right borrowing capacity for that client, because sometimes, depending on their circumstances, they might need to go to another lender to get the loan that they need.
Yeah, right. So maybe they wouldn't meet the needs of the bank, but you'll be able to find them a bank or a lender that'll actually comply or help them with their needs.
Yeah, correct. Because every lender has their own way and product niches that they assess an individual client's circumstances. So you might think that because I have a similar job to the next person, but when you're looking at the whole scenario, that might not be the best option to go to their direct bank. Right. And the good thing is with a broker, they can assess the entire market and they can see which, I suppose, lender can find, you can find the right borrowing capacity for them, the features that they need at the most competitive interest rate. Right. And the good thing is too, when you're seeing a broker, we actually don't charge an additional cost to the end client because we get paid via the product. Right. So it's no different to say if your clients went to every individual institution in the market, which obviously would take a long time and not understand all the various products out there in the market. Yeah. They're essentially going to a broker. They can do that at no additional cost because we receive a commission for the product itself.
I see. That's one of the things that people are often suspicious about. So I think they're being ripped off by going to see a broker as opposed to the bank. That's not the case.
No, and there's been a massive shift with going direct to a bank to a broker. These days, apparently, most loans are written by a mortgage broker at around about 70% of lending, because it's more like the trust of going direct to the bank is slowly waning, and the credibility of a mortgage broker and what they'll do for the end client is definitely gaining a lot of traction.
And there's a lot less places to go to banks now too, isn't there? Because a lot of them are closing their doors in terms of physical locations.
Yeah, correct. And often if they try and give a bank a call, long wait times, or you go to a branch, they want to try and speak to the same person they spoke to last time, they're not there. Yes. So there's a lot of angst with that. So when you're dealing with a broker, they're the ones that are actually going out to the market. We have our own relationships within each and every individual lender. And because they know that I can take that loan to many institutions, they're quite competitive on trying to win the business of your client's loan.
Got you. What's this thing that we've been hearing a bit about, which is the first home guarantee?
Yeah, so the first home guarantee scheme, essentially it's a program in place for a person to buy their first home where they only need 5% of genuine savings instead of a traditional 20% deposit. What happens is if they've got that 5% genuine savings, the government will actually act as the guarantor with the lender for the difference between the deposit the client does have until they have the 20% deposit. And what that does, it actually avoids the client having to pay lender's mortgage insurance, which is essentially an insurance premium that they are paying the bank's insurance premium on their behalf. So it can save quite a fair bit of money. Usually, it's no short of being tens of thousands of dollars for that lender's mortgage insurance premium.
And I guess people who may have not been thinking that they could buy a home until this has come in would now be in a position to actually borrow money. Is that
correct? Especially in a period when we're in a market where growth is escaping a lot of people. So the amount of time it takes them to save that deposit to go in and buy that home, what that guarantee scheme, it does give them the ability to go, okay, I can actually now access buying a property at reasonable rates, because another part is when you're in that guarantee scheme, you actually get the interest rate as if you did have a full 20% deposit.
Nice.
So it's not like you're also getting a higher interest rate because you have a small deposit under the scheme. That's an additional benefit. So you get a more competitive interest rate, and you also don't have have to put down a larger deposit for the loan.
Sounds like that's a good thing for consumers, right? For borrowers, or is there a trap in part of this?
Just the hard part, it is a competitive market, as you know, right now, and probably a lot of your clients, if they've spoken to me, that is probably the issue. One part that misconception is that when the postcode limits, so they'll have a limit on what the guarantee scheme fits in, like say for Brisbane City, it's $1 million.
Okay.
So with that though, is that when the federal government changed the scheme to fit within those limits, the state government didn't change the stamp duty concessions for that. So say if you're in the middle where you've gone above stamp duty concession, which tapers off at 750,000, you are starting to pay stamp duty. So you've got to make that allowance to pay for that, as well as your deposit to meet for the guarantee scheme.
Well, hopefully they'll still help people out a bit.
It certainly does, because it's right now it is allowing people to access the market, and because there is a bit of an issue of them being able to save the deposit faster than the growth of the property market keeps escaping them.
Yeah. I think you've answered this, Daniel, but something that people want to know is whether brokers save money for the client, really, in the long run.
Yeah, so I think there was a survey recently conducted by MFAA, which is like the Brokers Association, where on average it's a 0.3% saving on interest on a loan. So the whole idea is that when seeing a broker, they are trying to find the most competitive rate. Sometimes the most competitive rate or cheapest rate is not necessarily the right thing, because that products might not be suitable for that individual client, or their time frame to actually execute the loan for you to purchase the property might be far outside of their scope to actually implement the loan in time.
Nice.
So like, say I know one of the cheapest lenders in the market in interest rate at the moment, their time to actually do the loan is like 30 days for assessment. So if you were trying to be competitive and try and get a contract on a property to purchase,
Yes.
it doesn't almost matter, because they won't be able to execute the loan in time anyway.
The seller's only interested in it.
Correct.
Right, fair enough. Is there a cost to refinance?
There is a cost to refinance, and it's important that people understand that. So in general, it would be about $1,000. Where that money comes from is because you have to deregister the mortgage with the existing lender, re-register it with a new mortgage, and usually there's an outgoing fee from the lender as well.
Right.
For where they're coming from, like an administration fee. Generally, it's about $1,000. So if you're seeing a broker, they would assess that. They go, well, is the interest saving on the loan going to be worth paying that cost?
Right.
Now, that's not a cost you physically have to have cash in your bank to pay. That'll essentially be added to the loan when you're transferring the lender. A decent broker will be making that assessment for you to go, well, they've only got $200,000 left on their loan. There's only going to be 0.2% saving on interest rate. Likely it's not going to be worth it. But if your loan is like, say, $750,000 and it's a 0.5% interest rate drop, I'm pretty confident it's going to be worthwhile changing.
And this probably feeds into the next question. This thing that I've heard about, loyalty tax. What's that about?
It essentially means that if you're being loyal to your existing lender for a long time, essentially they do a version of taxing you, where because they will build out a higher interest rate than if you looked with another lender and actually assessed the market, what's out there for you. Gotcha. So you're actually paying more interest on your loan than you necessarily should if you actually went out to the market and assessed what's available to you. So they're banking on the fact that you'll just be loyal to them and they will creep in extra profit for themselves, and they want you to do that. So that's why the broker market has disrupted that. So we've actually tried to drive more competition in the market. I see it all the time, especially when people are coming off long-term fixed rates. Right. Generally, that's the time when the lender will create that sort of extra buffer of interest rate.
Is it all built into the loan, or are they actually sort of putting it in there surreptitiously later?
No, they'll just, when they're coming off that fixed rate, or they're just not passing on the, I suppose the most competitive rate to it is if you're going to be a new customer to the bank. I see. So it'd be really easy for the client to tell the go, what if they went online and said, what's a new customer getting that bank? And they'll go, what am I actually paying? I go, oh, that's actually fair bit of difference. The difference is also by going to a broker, we can also negotiate lower interest rates compared to what you see on the advertised ads.
Gotcha.
So some lenders, depending on the loan and your loan to value ratio, so the difference between your debt and the value of your property, these metrics can weigh up to see if the broker can actually obtain an even more competitive rate that's advertised in the market.
And for our clients to meet with you and talk to you to get an assessment of that, there's no cost in doing that, is there?
No, it's complimentary.
Yep.
Only cost is their time and my time.
Yep.
But there's no fee being charged, that's for sure.
Yep.
So I'd always encourage people to book in a meeting. I essentially send a link with a link to my calendar where they can book in a time that suits them, not me. So they can book in a time that's going to work within their schedule.
Yes.
Especially understanding a lot of your clients work in various shifts, so it's not the usual hours.
Yes.
And then I also encourage people, like say, if one of the times it's not available, I need to speak to me, just send us an email, give us a call, and I'm happy to speak to you. I'll work around it.
Appreciate that. So it's like a little bit of a health check for their mortgage to see whether they can do better.
Yeah, and quite often I'll even tell people that they're actually on a really good competitive rate.
Yeah.
Or the cost of transfer is not worth it to them. So I think that's why, like, probably you feel comfortable referring to me, because I'm not then just going to try and shift for me to make revenue for myself. I think it's the right thing to do, to just go give people a check, answer a few of their questions to see if they're actually on the right path. Yeah. Or sometimes it might be one of your clients, but they're kids of the clients. They might be the ones doing their first home, or they're trying to set them up, or do how can I pay for a renovation, all these things that might happen over the course of your life.
And I suppose in that regard, there's a lot of options now, isn't there, for the next generation of kids who they can, with their parents helping them out with guarantees and things like that. Is that something that you get involved with?
Yeah, correct. We talked before about the first home guarantee scheme, which is the government is acting as the guarantor, but then also your parents, or if they're a parent, or a family member, close family member, can also act as a parental guarantor, where they can use the equity in their home. So that's below, so you've got the value of the full property, less 20%, because you can only ever borrow up to 80% value when you're doing a guarantor.
Yes.
And then the difference between their loan, or hopefully there's no loan, makes it a bit simpler. And that's the equity that they can use to act as a guarantee to help their children buy their first property. And the downside of that is there might be a legal fee where they will have to go and seek independent legal advice, because the lenders want to make sure that the parents are actually going in understanding their full risks to them. One part is that people don't realize that usually you're only actually guaranteeing the portion difference of getting that 20% deposit.
Yes.
So they're not actually using their entire equity of their property, just the portion that's required to meet the guarantor. And then once the value of the property is increased, or the person has paid down the loan, then you can ask for a release from the guarantee as well from the lender. So it's not always going to stay there.
Build it back into the actual property.
Correct.
Okay. And what are your opinions on weekly or monthly repayments? Is there a difference over time?
Yeah, it's one of those myths that keeps putting out the market. This is how you pay down your loan faster. Essentially, all what it really is that if you obviously pay, there's 52 weeks in a year, right? And there's 12 months in a year. So all it really means is it's just an extra couple of repayments that is actually being made. Right. That's the only difference. The real way how you help pay down your loan faster, you can still have the monthly repayment. I would probably just suggest whatsoever in your income cycle. So if your employer pays you fortnightly, adjust it to fortnightly, it's monthly, weekly. But the important thing is, it's just the difference between what you earn and what you don't spend. Just put that in your offset facility, and that is actually how you pay down your loan faster. Right. Putting all that extra money on the home loan, either in your actual home loan, in the redraw, or in the offset facility, because the interest on the loan is calculated daily.
So it reduces the interest on the loan.
Correct.
But it's sitting there so you can access it later if you need to.
Correct, yeah. And that's the benefit, I suppose, more of an offset facility. And in general offset, if your loan has an offset facility, the interest rate might be slightly higher, but I believe it is actually more common that it is well worth paying that fee, because you can then have your income automatically deposit into the offset facility, because before you eventually having to use that income for holidays or groceries or whatever it is, in those few days, it's offsetting interest on your home loan.
Gotcha. That makes sense.
It's obviously hard to calculate what that benefit is. You'd have to spend a whole year calculating that, but there is a certain benefit there to the client.
How do we trust the banks to do the right thing in terms of that interest reduction? Do we know that they're doing it?
Well, they advertise it, and I think it goes back to the John Howard era, where they put a lot of pressure on the banks to pass on the interest rate reductions as they occur. I think there was actually an interesting podcast that Mark Boris had John Howard on his podcast recently, and he spoke about that era where he put pressure on Mark Boris's company back in the day.
Right.
It was an era when the banks used to, let's say when the RBA passed down an interest rate reduction, the banks would use that extra 3 months before they pass down the interest rate reduction. Now, essentially, it happens the next day.
Yeah.
there's been pressure over on the long term, because they used to use that time as an extra buffer. So you'd find that the major banks are very good at passing that on these days. They might sometimes take a little bit longer, but where there's been a lot of pressure recently that there's been a cost of living crisis,
Yes.
they've been quite good at passing on those rates. What a lot of people don't realise though, when the interest rates do drop from the RBA, then the individual lender they have will say, okay, we are going to pass on said rate, that it actually doesn't reduce your repayments on your loan. Some lenders can do it automatically, but in general, they stay, if you're on a $1,000 a month home loan repayment, they will keep it at $1,000, which I actually think is a good thing because it's helping you pay down your loan sooner.
Right.
So it's creating more buffer because you're paying down that loan sooner. If you really needed to, and you wanted to lower your minimum repayment to adjust to the interest rate deduction,
Yes.
you can ask them to do that. But I think it's actually a good thing to say, just stay where it is if you can afford it,
If you can.
because it means you're paying down your home loan faster.
Gotcha. Some people can't, of course, they need to
Yeah,
take that buffer.
if you're under financial pressure, of course, then speak to your broker or speak to the bank, and then they can adjust the minimum repayment, because now the minimum repayment would have gotten lower because the interest rate's gotten lower.
And in terms of the life cycle of the loan, is that something that our clients come back to you about as the broker? Like it's not a set and forget thing when you sign the loan and do all that, you just walk away, or can they keep coming back to you to say things like that? We want to reduce our repayments.
Yeah.
And take care of that for them.
Yeah, so I suppose I'm not so sure if every broker does this, so I'd probably say a good broker should be doing this.
Yeah.
So my own business, so say we not only help people, I suppose, find the right loan for them, but then we also help them all the way until the loan settles, and also connect into parties they might need to in the processing. That could be a conveyancer or various parties. But then also after the loan settled, we will check in with them a few days after, make sure they know what their loan details are, make sure the offset's set in if they ask for an offset, have a 45-day check-in, and then we have a cycle of every 6 months from there, where we actually check in on that with the lender. This is a proactive thing that we do. We go and check for the lender, see if we can get a reduced rate from what they're already paying.
Wow.
We also send them a property report, because then they can track to see how their property is actually faring, the increase in value, what recent sales they're having. So they're getting that connection along the way.
Yeah.
We also have a newsletter that goes out to them to sign the information. So that's probably less personalized, the newsletter, but I suppose the stuff that's related to them, we have that connection along the way. I don't believe it stops just because we've completed a loan for them.
Yeah.
I want to help them along the way. And as I've noticed that they've got more equity in their property along the way, then I'll ask them and say, if you want to speak to other ways on how you can start maybe investing in property or other means to, I suppose, create their wealth, not just paying down their home. People probably hear a lot of what's called a debt recycling strategy, and that's what that essentially is, when essentially you start borrowing to invest to create deductible debt, then use that income from the deductible debt and investment property to help pay down your home loan, which is a non-deductible debt.
Gotcha.
Okay, it's creating that structure, and that's probably what they're hearing when they're seeing some probably spruikers on social media. They're saying, pay down your loan in 7 to 10 years. That's what they're essentially talking about.
It requires them to borrow more, get more debt.
But
it might work for them.
Yeah, it might work for it, and that's an individual circumstance. I don't think everyone should do it, because it's also back on their own risk appetite. Unfortunately, I came from a financial planning background and have a master's in financial planning, so I understand a bit more. Probably some people are spruiking that probably don't really understand the consequences.
Yes.
But for the right people, it can be a good strategy, and I think it's important that they seek advice from a financial advisor.
Yes.
To ensure that is the right process for them.
Well, thanks, Daniel, for coming in. So as you know, we have a great partnership, and you're on my website. People who are interested in your services can click on that link, ask for more information. We'll get them in touch with you anytime. And they can also come to you, correct, and ask some questions?
Yeah, so if they come via yourself, and then you could sort of send me an email, let me know, or if they see me via your website and just contact me directly, that's fine as well. Probably just let me know that you've come from Sibley Lawyers, so I know that sort of the, I suppose, additional services I offer to Sibley Lawyers clients, that you'll get that, and I can certainly thank yourselves at Sibley Lawyers for the referral. Then really appreciate the support and also working with your clients, and hopefully we can help a few more.
We appreciate it too. Thank you.
Cheers. Thank you.
Cheers.